Hi friends, today we will talk on the topic of affordability analysis. It is very common for us to overspend. We go ahead and buy things beyond our means, and often this kind of spending is beyond our control. So, how to control this overspending? Though it is not an easy thing to do, but for sure, if we have a rule in our mind, then probably the chances of overspending will reduce. So in this video, we will talk about that rule. But first of all, let me emphasize an example highlighting how we are lured into overspending. Suppose there are two friends. One is a rich friend and the other is not so rich friend. The rich friend makes about 10 lakh rupees per month as a salary, and not so rich friend is making about 2 lakhs per month. So the person who is very rich, he has the habit of changing cars every 3 years, and every time he buys the car, he buys around the car which is approximately of 30 lakhs cost. So you can see what the rich person is doing here. He's buying a car which is approximately 3 times his monthly income. So let's assume that this purchase of 30 lakh car by the rich person falls within the affordability range of the person. This is just an assumption. There is no rule. This is just an assumption that because the rich person is buying a 30 lakh car, which is approximately 3 times of his monthly income, is within the affordability range. Just an assumption, okay? So, seeing this habit of the rich person, the not so rich person also thinks that he should also buy a car, but he knows that he cannot buy a 30 lakh car every 3 years. So what he does, he buys another car which is of approximately 16 lakhs. So what this not so rich person is doing, you can see his monthly income is 2 lakhs. He's buying a car every 3 years of 60 lakhs cost. So he's actually spending 8 times of his monthly income. On one hand, the rich person who is buying a car which was 3 times his monthly income, and now this not so rich person, though he's buying a slightly less expensive car, but still that car is 8 times his monthly income. So this is an example which highlights that how we middle class people overspend money. We see somebody, we take it as an example, and we try to incorporate it in our life, leading to overspending. So this is something that we have to stop, and if we can stop overspending, a lot of balance will be there in our savings, and that balance we can invest and build wealth in long term. So in this video, we'll talk about a rule, and we will also see examples that will tell us how we can apply that rule that will help us to stop overspending. Common man has 3 sources of funding which they can use to buy a thing. The first source of funding is their monthly income, the salary that comes into their savings account. The second is savings that they have accumulated, and the third is loan. They can borrow money from the bank. So these are 3 sources of income: their salary, their savings, and the loan accessibility. Let's take these 3 sources of funding and quantify a rule that will help us to prevent overspending. Let's see how this rule works. First of all, this rule says that buy a thing from your savings. Suppose you want to buy a mobile phone, and that mobile phone is, let's say, costing 35,000 rupees. So check into your savings account. In the savings account, please check that if you have saved 35,000 rupees for your mobile phone. Yes, it's very important. Maybe your savings account has 3 lakhs rupees, but in that 3 lakhs rupees, is there any amount allocated for buying a mobile phone? Our savings should not be stacked as a lump sum amount. It must be distributed on different expense heads. For example, here we want to buy a mobile phone, and that mobile phone's cost is 35,000 rupees. So even if we have a 3 lakh savings, we have to ask ourselves that how much money in that 3 lakh rupees we have allocated for buying a mobile phone. If you have not allocated 35,000 rupees for the mobile phone, this phone becomes unaffordable. So rule number 1 is buy a thing which is straight from your savings. Suppose you do not have that much saving, 35,000. then what you can do, you can dig into your income. So how much we can dig into our income? 10% only. So suppose you have an income of 1 lakh rupees per month. So 10% of 1 lakh will be 10,000. So you can take some money from savings, take some money from your income, which is 10,000 rupees, and together, if it can help you buy a mobile phone of 35,000 rupees, go ahead and buy it. So for a less expensive item like a mobile phone, this will work. Now let's suppose you want to buy an expensive car. So probably you will not have savings of that much. Probably neither your 10% income rule will give you enough money to buy a car. In that case, you will have to opt for a car loan. Now here the rule is the EMI of your loan should not be more than 5% of your income. If your income is 1 lakh rupees, your car loan EMI should not be more than 5,000 rupees. If you are buying a car, if you are taking a personal loan, if you are taking a car loan, the 5% EMI rule will apply. Now suppose you are buying a home. In that case, the limit of EMI is increased to 25%. So this is that affordability rule. Let me summarize it for you. First of all, if you have to buy a thing, you have to buy it first from your savings. Build a savings for that item and then go ahead and buy it. Now suppose you do not have that much saving, then you are allowed to dig into your monthly income. In a month, you can take out at least 10,000 rupees from your income and buy a thing. So you have savings, you have income, club it together and see if you can afford to buy a thing. Now suppose even joining these two things, you are not able to fund your purchase. Then in that case, you can opt for a loan. But the rule is the loan's EMI, the monthly EMI should not be more than 5% of your monthly income. This is a stringent rule, but it is very, very effective. It can certainly prevent people from overspending. Now let's understand this rule of affordability using an example. Suppose you want to buy a car which is of 25 lakh rupees. Your monthly income is 2 lakh rupees and you have a savings of 8 lakhs 75,000 rupees to buy a car. You have the savings specifically to buy the car. So let's apply this rule and see if the 25 lakh car is affordable for you or not. So first of all, you have a saving of 8 lakh 75,000. So this is tick. You have 8 lakh 70 out of 25 lakhs. You already have 8 lakh 75,000. Now let's dig into our income. How much is the income? The income is 2 lakh rupees. It means you can take out 10% from your income. So 10% of your income is 20,000 rupees. So now you have money from two accounts, 8 lakh 75,000 from your savings and 20,000 from your monthly income. So till now you only have 8 lakh 95,000. So now you will have to take help of the car loan. If you take a car loan, the maximum EMI that you can pay for the car loan is 10,000 rupees because we are applying that 5% EMI rule. 5% of 2 lakh rupees is 10,000 rupees. Will fetch you a loan of a car loan of approximately 10 lakhs. So now you have 20,000 from your income, 8 lakhs 75,000 from your savings and 10 lakhs from a car loan. The total of all of this is 18 lakh 95,000. So what does it mean? It means that 25 lakh car you cannot purchase. It is beyond your affordability limit. You can buy a car which is 18 lakh 95,000 worth. We will take one more example to understand this rule of affordability in a better way. But before taking that example, let me give you another concept that often confuse us about our sense of affordability. Suppose your monthly income is 2 lakh rupees and you go to a bank and apply for a home loan. You will see that the bank will easily sanction you a loan of about 1 crore. I am also assuming that you do not have any other loans running in your account. So a person with 2 lakh per month income applying a home loan will easily get a loan of about 1 crore. So a 1 crore loan, a 1 crore home loan will cost you around 1 lakh per month in the EMI. So you have an income of 2 lakhs and you are paying a EMI of 1 lakh. So about 50% of your monthly income will go as the EMI. So when you approach a bank and your bank sanction you this kind of loan, it gives you that perception that you are actually able to afford this loan, but it's not. Consider this: out of your total monthly income, you are paying 50% in the EMI. By any personal finance rule, leave aside the personal finance rule, use your logic. You are spending 50% of your income on something else. Is this affordable? Absolutely not. This is where my 25% EMI rule for home loan comes into play. So if you have a monthly income of 2 lakh per month, then the maximum EMI that you can afford to pay is 50,000 per month, not more. So don't get confused by the rules of the bank. If the bank is able to give you a lot bigger loan, you are able to pay a lot more EMI, then don't get confused that you are actually able to afford that purchase. No, the bank's rules are like that. They are framed in such a way that when a person applies a loan, he gets a loan. To judge your affordability factor, use the rule of affordability that we are talking about here. Don't use the bank's rule as your benchmark. Now let's see another example to understand this rule of affordability in a more clearer way. Suppose you want to buy a furniture which is costing you around 1 lakh rupees and your monthly income is 2 lakh per month, and let's assume you have already exhausted the loan limit. You are already paying an EMI, a personal loan EMI of 20,000 per month. So you cannot take more loans, but you have to buy this furniture, and this furniture is costing you 1 lakh rupees. So what you will do? You will have to dig into your income. So from your income, you can take out how much? 10% of your income. 10% of 2 lakhs is 20,000. So you have 20,000 rupees. Now you will have to see your savings breakup. In the savings account, let's suppose you have 3,93,000, but under the furniture head, you have only 50,000 rupees. So let's see how much your funding is able to generate cash. The income is giving you 20,000 rupees, loan you cannot take, and from your savings, you are getting only 50,000 rupees. So adding these two, we are getting a funding of 70,000 rupees, but the furniture is actually costing 1 lakh rupees. So you cannot afford to buy a furniture of 1 lakh. What you can best do is you can buy a furniture of 70,000 rupees. So applying this rule of affordability will give you a lot of clarity that what you can afford and what you should either wait or you should avoid.